So let's say we take 80 grand in NOI savings and you divide it by a 6% cap rate. The increase in the property value of 80,000 divided by 0.06% equals 1.333 million in valuation. So that means your 80,000 in annual savings just added you 1.33 million to the value of the property. In addition, the 80K extra is cash flow each year due to the reduction in a real expense. Ladies and gentlemen, welcome to today's episode of Multifamily Investing 101, the power of passive investing. You know, whether you're a seasoned investor or just starting out and exploring the world of real estate, this episode is going to touch on some value for you. We're going to cover why multifamily real estate stands out, the difference between passive and active investing, some of the common mistakes that you can avoid, and how you can get started if you're interested in investing in multifamily properties and have not done so thus far. Again, so if you're a beginner or you've been doing this for a long time with a diversified portfolio, multifamily real estate offers significant advantages. Some of the focal points for us is cash flow and then tax savings through depreciation. And our goal is to control the tangible assets, meaning assets that can be touched and are real and are not something that is a number on your phone. So let's dive right in. Multifamily real estate has historically provided excellent protection against inflation. And, at Granite Towers, we're constantly searching for great multifamily deals because of the cash flow they generate, the tax savings they offer, and the control that we have over the physical property themselves. These are tangible assets. Again, stuff we can touch, we can visit, we can improve, we can directly control. These assets, drastically change performance based on where we are in the market cycle. And for those of you that are listening right now, we've been through a lot of pain over the last 2.5 years. Interest rates have been rising. Expenses have been going crazy with taxes and insurance. And we're in a totally different season right now than we were 2.5 years ago. Interest rates look like they've topped out and the Fed has started to cut them, because when interest rates rose, cap rates followed, you guys. So when cap rates rise, values come down. Because the way these properties are valued is NOI, which is just simply income minus expenses, is net operating income. If you take income, the rent income, other income, and you minus all the expenses, you're left over with your net operating income. If you take the net operating income and you divide it by the market cap rate, that's your value. And when cap rates go up, values come down. And even if you add tremendous value through net NOI growth, it's still likely you're flat or upside down in some of these deals. And so we've seen tremendous cap rate expansion over the last 2.5 years as interest rates have gone up and values are way, way down compared to where they were in late 21, early 22. When we talk about control, we mean the ability to directly impact the performance of the property. For example, we may implement some value add strategies such as upgrading the interior of the units, or we're going to be offering a Wi-Fi package. Wherever we can increase the property's income, that would be a value add strategy we would be considering. And you can also do value add strategies by reducing expenses. Maybe you're going to do a utility upgrade and put in low flow toilets throughout the whole property to bring the water bill down. Another value add strategy. Now, if you compare that to something like investing in Tesla, if you saw earnings decline, you're not likely going to get Elon Musk to adjust his business plan. Obviously, Tesla's a bad example because the stock's been going in an amazing direction. But if you have stocks that are going down, you don't have much of a say. Whereas a passive investor reaching out to the general partner and having a discussion with them and saying, hey, what are you guys doing? What can we adjust? That's a total feasible business plan and something that happens often with our investors. So breaking it down, it's as simple for us as increasing income and reducing and controlling expenses to, again, increase the net operating income. That's our entire focus on every deal we buy and own and operate, is simply to drive NOI. The value of these buildings, again, they're calculated by taking the NOI and divided by the market cap rate. And the NOI we have a lot of control over. And of course, cap rate compression or expansion is not in our control. So that's the variable where we have to be clear on where are we about in the real estate market cycle. And if you know about where you are in the real estate market cycle, it puts a lot of wind at your sails as you look forward for the next 2, 3, 4, 5 years. And based off of what we just saw over the last 2 years, it's very likely that interest rates, have either peaked or will be coming down over the next 2 years, which means it's possible or much more likely than it was just 2 years ago to see cap rate compression. And when that happens, when cap rates are high and come down, mixed with a value add strategy, that's when you start to see these home run sort of deals. And home run sort of deals were happening in 2021. You'd buy a deal and you'd get 50 to 100 basis points of cap rate compression. Rents were going up at 15 to 20%, and you were seeing these insane returns in multifamily real estate. And that's not sustainable. That's not something that's normal. That was a unique moment in time at the end of a market bubble peak. And so as it resets and starts to gain that foundation of the bottom, we can start to build from here and have a much better chance of success. One thing I hear a lot of investors saying right now is I don't want to invest. My deals didn't do well from 2021 and 2022. And the part I would just have you think about is if you're investing in the rearview mirror, looking back at what was, you're not investing with the right mindset of what's coming. And so you just make the assessment, what's likely coming over the next 2-3 years? Are interest rates going to continue to rise, or have they peaked and is likely that we go into some sort of a recession and interest rates come down? And so if that's the case, now could be a great time to be buying. If you think rates are still going up, I would definitely wait then. And that's up to you to do your own research on. We believe that rates have peaked and we're going to see them come down or at least stay flat to where they are over the next 2-3 years. One of the primary reasons we love multifamily is the passive income it provides, or another word is cash flow. After all the property expenses are paid, including the debt, the leftover income becomes the cash flow, which is distributed to investors. And at Granite Towers, we process distributions quarterly. So every month, our management team collects the rent, they pay all the bills, and whatever remains is distributed to investors. And as a passive investor or a limited partner, this allows you to receive passive income while focusing on your career or your business. So you're essentially building multiple income streams without having to manage the property yourself. And we're going to talk more about an active versus passive investor in just a few minutes, but think of it as though passive income should be money you make while you sleep. And not every deal is going to create as much passive income as others. Different market cycles are going to change those scenarios. But if you've bought a great deal in a great location and you've put the right business plan in place and it's being managed effectively, overall over a 5 to 7 year period, that deal should likely appreciate. And we're going to talk about forced appreciation here. Another key advantage of multifamily investing is forced appreciation. And the difference from market appreciation, which occurs when a property's value rises due to market factors like you've got increased demand or lower interest rates. With forced appreciation, we actively increase the property's value by increasing income, which is where we're adding real value to the residents who live at the community. And this value add could involve, again, a plethora of plays. You might renovate units. We might upgrade amenities. We might enhance utility cost control through LED or upgrading water conservation programs. And so if I walk you guys through a simple but pretty powerful example of how a small operational improvement like installing low flow toilets can significantly increase the value of multifamily property, this is what it would look like. So let's say you've done your research, you've decided you want to install low flow toilets throughout the building, and it's going to cost you $100,000 up front. Now that might seem like a hefty investment at first, but let's look at the impact that $100,000 will bring for the utility upgrade. By implementing these low flow toilets, the projections show you're going to reduce your water expense by $80,000 per year. And there's companies that will project how much they will reduce your water bill by. And from our perspective, they've been extremely accurate and sometimes conservative. So essentially, this operational change is going to save you $80,000 a year in annual expenses. Remember, when we reduce operating expenses, it directly increases the net operating income. Our whole job at Granite Towers is to drive net operating income. Now, here's where things get pretty interesting, is that $80,000 savings is money that stays in your pocket or in the business as an increase to the NOI of the property by $80,000 every year. So your cash flow just went up by $80,000 a year. But the real value of this increase comes from something called a capitalization, or capping the NOI increase at the market cap rate. Break it down simply. You take the $80,000, which is your NOI increase, divided by the market cap rate. So let's say we take $80,000 in NOI savings and you divide it by a 6% cap rate. the increase in the property value of 80,000 divided by 0.06% equals 1.333 million in valuation. So that means your 80,000 in annual savings just added you 1.33 million to the value of the property. In addition, the 80K extra is cash flow each year due to the reduction in a real expense. Now you think about that for a moment. If you invest 100 grand to install the low flow toilets, but in return, you've increased the value property by over 1.3 million. That's a massive return on investment. That's 13x your cost. Plus you've got the 80K each year. Now, keep in mind, if cap rates increase or go up and you do these value add plays, you're not going to have nearly the value increase. And a lot of you folks that have invested in deals that were in 2021 or early 2022 or even in 2020, you had a lot of cap rate expansion from where they were purchased. So your operator may have, and some of our deals may have had tremendous NOI growth, but because cap rates went up, values aren't where they normally would be. You're not seeing the same bang for your buck. The inverse of that is the deals you're buying now, you come in with a value add strategy and you might get cap rates to come down. And if you have a combination of NOI growth with cap rate compression, your valuations are going to start to do much better. So this is just one of the reasons we love multifamily. The value add play is great for the environment. This is a small operational change where we can create huge success in a property by increasing the utilities of the property. And again, you're increasing the NOI. And when you capitalize that by the market cap rate, you will see some massive property valuation gain. So whether it's water conservation or installing property-wide Wi-Fi or other value-added strategies, these types of improvements are powerful tools for multifamily investors. And that's why we're always on the lookout for opportunities like this to force value at our properties. The next point I want to just discuss with all of you is reduced volatility. So talking about multifamily real estate particularly, it's less volatile than stocks. And I want to break this down in a way that makes a lot of sense to you. And you might hear the term standard deviation when we talk about volatility. So let's just start there. Standard deviation is just a fancy term that measures how much returns can fluctuate from an average over time. So in simpler terms, it shows how much an investment's return tend to go up and down, and the higher the standard deviation, the more unpredictable or volatile an investment is, the lower, the more steady it is. So if you compare real estate stocks using standard deviation, when we look at returns from say 1970 to 2010, real estate has had a standard deviation of just 10.86%, while stocks had a much higher standard deviation of 17.91%. That just simply tells us that stocks are more volatile, meaning their returns fluctuated more widely compared to real estate. What about returns? When you look at that over the same period, stocks had an average annual return of 17.91%, which is higher than real estate average annual returns of 10.86. But the key difference is that real estate provided more consistent income. So on average, real estate generated 6.4% in income return, which is also known as cash flow, compared to 3.46% from stocks. So even though stocks may show a higher return overall, those returns are much more unpredictable. And with real estate, you get a steadier return and, more importantly, higher cash flow coming in quarterly. That's why multifamily real estate is often seen as a safer asset, more stable investment, especially if you're looking for that residual passive income. Another thing to consider is that some investors simply prefer not to see the day-to-day volatility, whereas with stocks, you can check your account daily and watch your balance fluctuate widely. And, for me, with being in stocks or in crypto, I might be looking at my account 4 or 5 times a day when it's changing a lot, and it adds some stress or major excitement, and you have these ideas of selling. And with real estate, you don't get those constant price swings in front of you. Instead, you can trust a long-term investment thesis, knowing that over time, the property will generate steady income and appreciate in value if it's operated well, bought right, in the right location. Now let's dive a little deeper into a concept called economies of scale and how it plays a big role in making multifamily real estate such a stable investment, even during uncertain times. First, the basic idea of economies of scale simply means that as the size of the operation grows, the cost per unit typically decreases. And in this case of multifamily real estate, the more units you own in a single property, the more efficient your costs become. And this can lead to greater stability and profitability. So if we look at a real life example, we own a 150 unit apartment building. We have a lot of tenants contributing to our overall income. So let's just say worst case scenario, we lose 10 or even 15 residents. That sounds like a lot, but if you step back and do the math, you're still 90% occupied. The impact of those vacancies is minimized because the remaining residents are still paying rent and your overall income stays relatively stable. If you compare that to something like a single family home or a duplex, if you lose even one tenant, this could mean 50 or 100% drop in income. So economies of scale goes even further. With large multifamily properties, we can spread out fixed costs like our property management costs, maintenance, repairs. We can spread that across more units. So this means the per unit costs are lower, which helps boost our net operating income. So while we're operating at a larger scale, the cost to maintain each unit actually decreases, which improves our overall profitability. Another benefit of economies of scale is our ability to negotiate better deals with vendors and our service providers. So for instance, if we've got 150 units, we have more bargaining power to negotiate bulk discounts on things like repairs, maintenance service, Wi-Fi, upgrades, flooring, appliances, all these different value add strategies. And these cost savings further improve our bottom line and keep our operating costs in check nicely. So economies of scale in multifamily really creates a layer of protection. It helps reduce risk by keeping our cash flow stable, even if we experience vacancies. And this allows us to operate more efficiently, really driving down costs and expenses, which helps us maximize our returns. When we're looking at inflation, multifamily is an excellent hedge against inflation, really because the way leases are structured. So in multifamily, a lease term is typically 12 months and are often even shorter, which gives us the opportunity to regularly adjust rent to keep pace with inflation. If you compare that to industrial or retail properties where lease terms can span multiple years, it makes it harder to increase rent as inflation rises. So with multifamily, we can stay agile, adjust rents more frequently to really match the rising costs of living and protect investments. One thing that keeps ringing true for us is that inflation is unlikely to go away as the federal government continues to print and the Federal Reserve continues to print money. As they print money, that used to be the definition of inflation. And every single currency in the history of the world, if you look back, has either been replaced or gone to zero. So if every currency in the history of the world, and the dollar is a currency, it's not money, it's currency, has been replaced or gone to zero, you have to start to look for ways to hedge against inflation. Tax benefits. Let's talk about one of the biggest perks of multifamily investing is the tax benefits. And real estate offers tax advantages that simply aren't available with other investments. When we purchase a multifamily property, we conduct a cost segregation study year one. In this cost segregation study, it really allows us to depreciate the property more quickly, which means larger depreciation losses early on, which can significantly reduce your taxable income. For a quick example, let's say you invested $100,000 in one of our recent deals. Through depreciation, you might see around $40,000 in depreciation losses. And that amount can be used to offset income. It can reduce your tax bill. And if you don't use the losses in year one, you can carry them forward to future years. Keep in mind, everyone's tax situation is different. Not all types of income qualify for these tax write-offs. So it's essential to consult with your CPA. And I encourage you to reach out to your tax advisor and just ask what the benefits of depreciation would be for you. And if you can't use it and your advisor is telling you it doesn't apply to you, ask them how. Well, how does it apply? What do I need to do? How do I need to earn my income so that the depreciation will apply? Because I know it does for a lot of our investors, and I'm sure you've heard from a lot of our investors that it does as well. The next focal point for us is recession resistant. Another huge advantage of multifamily is it's recession resistant. Even in economic downturns like we're seeing now, people always need a place to live. It makes housing one of the most stable asset classes. And during recessions, many individuals tend to move away from home ownership and into rentals due to financial constraints, and this drives demand for multifamily housing. We're also currently seeing folks less likely to afford an average home just simply due to how far interest rates have risen, further pushing the U.S. into a renter nation. Unlike sectors like retail and office space, which can struggle during tough times, multifamily properties can have built-in resilience in most locations. And again, I emphasize most locations. Not all locations will have this. We bought property out in New Mexico that was purely dependent on oil. And when we went through the pandemic and oil crashed, we saw a negative effect in that submarket. So your location is going to drastically dictate the performance of these deals when the market's changing. And as we've seen in past recessions, people may downsize for living situations, but they still prioritize keeping a roof over their head. This steady demand helps multifamily weather economic downturns much better than a lot of other asset types. One example, during the 2008 crisis, while home prices plummeted, the rental market remained stable as foreclosed homes turned to renting. So keep that in mind as we go through whatever these next 12 to 18 months look like. And just quick, the top 7 reasons we invest in apartments, if you're not clear on them, is number 1, cash flow. We're looking for monthly passive income. How many multiple streams of income can we create? And can you get to a point where your monthly cash flow exceeds your monthly expenses so you can have freedom to be able to work or not work? Next is forced appreciation. We talked a lot about that already, directly increasing the property's value by improving income or reducing expenses to push NOI. That can be done through any type of value add strategy. We gave you the example of a utility upgrade by putting low flow toilets in, changing the valuation by 1.33 million. That's just one example of a forced appreciation value add strategy. Tenant diversification. Again, multiple tenants spread out the risk. When you have 5, 7, 10, 15 units vacant on 150 units, it's not going to completely wipe out your income. High demand. We've got massively rising home prices across the country. We're turning to a renter's nation. I think we can all see that. And interest rates are making it that much more of a renter nation, which increases and drives demand. The other one is tax benefits. Significant tax savings through depreciation and cost segregation studies, which legally helps you reduce your tax liability each year, giving you more money in your pocket to invest and work harder for you. And then recession resistant. People always need a place to live, even in tough times. It doesn't mean every deal is going to do well, but the right deals in the right locations tend to sail through these recessions pretty much unscathed. And then lastly is a hedge against inflation. You've got, again, multifamily rents rise with inflation, which is due to a shorter term lease, which helps us protect your cash, protects your wealth. We know long-term, the dollar's toast. Every currency in the history of the world has gone to zero. I've said this already, or it's been replaced. So it's critical you find a way to hedge against inflation, folks. Talking a little bit about passive investing versus active investing. Before we wrap up, I just want to briefly touch on the difference between the passive and active role. So with passive investing, you contribute capital to a deal and let the professionals like our team at Granite Towers handle everything else. From finding the deal to managing the property and eventually selling it, we take care of the day-to-day operations, raising the money, signing the loan, you name it. And this allows our investors to focus on their career or other priorities in their business while building passive income streams and still enjoying all of the tax benefits and other benefits we talked about in this episode. So you've got passive investors, they're referred to as limited partners. On the other hand, you've got active investing, which just simply means you're responsible for everything. So the deal, securing the financing, managing the tenants, raising the capital, overseeing the renovations, eventually exiting the deal. It is a lot of work and it requires significant expertise, which is why many investors choose the passive route. Usually people find it makes more sense to focus on their careers and become passive investors to still take advantage of the benefits offered by private real estate investments from what we've seen. In conclusion, I hope we laid out how multifamily real estate offers a wealth of benefits, and from cash flow to tax savings, risk mitigation, and protection against inflation, it really can be a great investment vehicle for anyone looking to grow their wealth, and it's accessible to get into and reach out to us. It's a very accessible way to, get involved in real estate investing without the headaches of active management. We view it as an essential component of a diversified portfolio for our investors. If you're interested in learning more or exploring upcoming opportunities with us, be sure to join our email list at www.granitetowersequitygroup.com/invest to stay updated on the latest investment options we offer. And we'll put that link below in our bio. And thanks for tuning in today, and we'll catch you next week.